There we go. Mm. Hey, Dex.
Hey,
All right. Got people coming in. Dex, have you met Mike before?
What's up, Dex?
hey, I don't
You-
believe I have.
No,
Yeah.
I don't think you have because Dex joined us just like maybe 3 weeks ago, is it? Something like that?
Oh, wild.
Yes,
Yeah.
Welcome. Congrats.
thank you. Thank you.
Cool.
Yeah.
Yeah, let's catch
Nice
up
meeting you.
after this if you like what I'm putting down.
There you go.
Gotcha.
You had to connect. All right, so let's go ahead and get started because I like to start on time.
Yep.
So most of you, as I was introducing Dex, I think everybody else knows Mike Jenkins from
Hmm.
Main Street Home Loans. But for anybody watching this recording later, maybe you don't, I'm going to put Mike's contact info in the recording later, so you can all receive it. And Mike's talking about today how to really structure your deal for success, right? In other words, sometimes we write an offer and we are competing with somebody else. Quite often that could happen where we've got competition and kind of like what can we do to make our offer the one that gets accepted?
Hmm.
Is that a good summary there, Mike?
Yeah, yeah,
Okay,
absolutely.
good. All right. Well, I'll let you go ahead and take it away, and
Awesome.
I'll chime in whenever you want me to.
Dexter, pleasure to meet you. I'm Marie. Dana and I actually just connected for just chatted. Good fun, long fun chat yesterday. Then Dallas and I have one under contract that Dallas, quick heads up, everything is coming along nice and smoothly. So no updates
Awesome.
because
Love to hear that.
we're rolling. So we should have it come out and underwrite it in hopefully the next couple of days or so. So yeah, today what we're gonna do is just go over some stuff to make your offer as appealing as possible. And sometimes you have some flexibility, sometimes you don't. So we're gonna kind of go over some of the aspects if you do have that flexibility. And so bear with me for a moment. All right. Let me see about sharing my screen. Love the Gamma. If nobody uses Gamma, I don't know if you guys do any PowerPoints, but Gamma is a very easy one. I probably put this together in just a couple of minutes. Made it super simple on purpose. Can you guys see my screen, or are you seeing the one with the FHLB, right?
Yeah, we're seeing FHLB.
So here we go. All right. Um, you have buyers. Hopefully, you have buyers and sellers. But if you have buyers, they're going to be looking to purchase the home and either paying in cash or they're going to be financing. Cash is awesome. Cash offers are excellent. Fantastic. If you have those, you are in hopefully a great position, but most of you aren't. Most of you are going to see a lot more financing here. And so that is something that the sellers are very much considering when they're looking to potentially take the offer. So they want to um, look at the overall picture of the financing, and some agents are a little bit more detailed, some are a little bit more open and flexible and care a little bit less. They're just excited to get a deal in. But what you want to do is try and find out as much information as possible because it's not always just about who's offering up the most money. Okay. Let's bring Stephanie Gaddy into the chat too. What's up, Stephanie? We're just getting started.
Hello, hello. How are you?
Good. We're just diving in. So we're going over how to structure offers if you have some flexibility. So a lot of you may be working with some first-time home buyers, limited amount of funds, need specific programs that might require certain timelines. So sometimes you don't have as much flexibility, but what you need to do there is then try and get a little bit more unique or strategic here. So we're going to kind of go over some of the bigger stuff to be on the lookout for, and then we can kind of open it up for situations and questions. All right. So obviously we want to make your offers competitive so that you can win more offers, get more deals, get more business, fill those pockets and spend because we got summer coming up. So everybody's probably looking to travel and get out and do some fun stuff. I'm assuming most of you guys are DC, Maryland, Pennsylvania. I mean, this is all going to be the same everywhere, just trying to focus a little bit more on the areas that we're working on. So, um, When you are preparing to submit an offer, call your loan officer beforehand and make sure you have it worked out. It's also good to make sure your loan officer is available. Dallas and I were putting together an offer last week, 2 weeks ago. Thought I was available all week and had some stuff pop up. So we had some little timing differences there, but we were able to eventually get the buyer under contract. And so what we want to do is just kind of work together here as we're submitting an offer to try and make it, again, strategically appealing to the sellers while also making sure that your buyers are doing something that's feasible and comfortable for them. So by connecting with your loan officer, you can find out the strength of the buyer, okay, exactly what they qualify for. Ask the question, as sometimes I kind of relay the information, sometimes I don't. There's sometimes two different numbers. There's a number of what the buyers might actually qualify for. Then there's what they're actually going to be comfortable with. Okay. Obviously, we all want them to be able to qualify for as much as possible so that you have, especially as an agent, have more wiggle room to go check out there and find more properties that might fit their wants and their needs. But at the same time, buyer might qualify for a $500,000 property. It does not mean that they're going to be comfortable with that payment. So we need to also work on that comfort level. These days, I feel like that is a little bit of a challenge here because everybody's looking for affordability. They want to buy a home, and sometimes that home that they want might not be quite where they want to be financially in regards to that monthly payment. We don't want to get them into something that they can't afford down the line, as much as they might get excited and love the house. And with you guys having the most interaction with them and working with the loan officer, hopefully myself or somebody from Main Street, working together to find that healthy spot there. You're going to be working with all sorts of different clients, and some people are a little bit more like stays cool and aggressive and like, oh, cool, I just must have this property. You knowing that, hey, like this is well above what we had originally talked about when we were structuring out the loan. But find out where they are. The other thing is like finding out how much wiggle room they may have, because when we're talking about a sales price and an offer, some buyers don't understand how much, or I should say how little of a difference you can sometimes make to the payment by just offering up a slightly higher sales price. And sales price is one aspect. So we're going to go over some other aspects because it's not the only thing. But if you have a seller that is only worried about their net, or you're up against competition, usually in a $250,000 to $350,000 price point, for each extra $1,000 that the buyer offers on the property is going to usually make about an average about $6 to $7 difference on the monthly payment. Okay.
Can I just interrupt you for a second, Mike? Because I use that number all the time. Like, if you didn't hear what Mike just said and you didn't write it down right now. What he just said was every $1,000 your buyer goes up is going to average, well, round ballpark, $6 or $7 added to the month. So when you have this buyer who's like sweating about adding, an extra couple $1,000s to their price, is it worth, $50 a month, $75 a month, whatever it happens to be, to get this house if this house is the one, right? Like, so if sometimes they need to put it in that perspective when you're thinking about the big number. Oh, if I'm going from 300 to 310, I'm paying $10,000 more, But if that's the house, no, it's $60 or $70 a month more. And that's a better way to think about it, is from that monthly payment. And sometimes I've had a number of buyers just like, that mindset helped them like get the house that they wanted. So
yeah, and that is a big hurdle too, because especially when they're getting into this, they don't know. I mean, they can see the numbers, what we've drawn up for them, but they don't know that difference. They don't realize that difference there. And so sometimes, I mean, it's always sucks. You find out, hey, you lost out for $1,000 or $2,000 difference, that somebody offered more for the house. You're like, oh man, but $2,000 or $10,000 seems so much more. But when you break it down to a smaller increment, that monthly payment doesn't seem as big a difference. It makes it a lot more palatable to be able to get a little bit more aggressive. And sometimes that can be that make or break of being able to get into the house. And you're not putting down an extra $1,000 or $2,000 or $5,000. So it's not coming out of your pocket. it's that monthly payment, especially if you have somebody that's either younger or newer in their job and they're going to be growing into their career, their position that might be making more money down the line. Say, hey, I know it's a little bit higher than what you were looking for now. Yeah, we don't want to see it hundreds of dollars more than where they were looking to keep it. But if it's a couple of bucks here, 60, $70, not a big difference. And that $6 or $7 is kind of based on today's rates, today's market. Obviously, if we're talking 2 to 3% interest rates or 10 to 12, that number is going to change a little bit. But that's a big one to relay and to remember so that you can help them out. Okay. Marie, you have a question? Can't hear you. You're mute.
Sorry, I didn't know that I was muted. Yes, Mike, I'm just want to try to also follow up with what you are saying because and when you are working with a client on the condo is different because I saw that some of the condo is very cheap, but the HO of it is almost a mortgage of 100,000 more. So yeah, since you are already on it, please, if you can try to explain that to us too.
Say that one more.
Thank you.
What's your question exactly?
My question exactly is when you are working with somebody who is buying a condo and then there's a HO fees,
Mm-hmm.
they make a difference because sometimes you have a condo that is having like a 700 to 1,000 of condo fees.
Mm-hmm.
Yeah, and what is that going to be on the mortgage of that person at?
So are you talking about what's the difference in like $1,000? So if we're talking
Yes.
a smaller sales price, you're going to be looking a little bit less. I'd say probably going to be about $5 difference on the payment. It's not going to be anything majorly different because we're talking about the principal and interest, which compounded over the course of 30-year term. So interest rates are going to be a little bit higher with the condo for the most part because condos carry more risk, but you're looking at a much lower price point. So I'd say you're probably looking at a $100,000 price point, about $4 to $5. So even if you're using that $6 or $7 equation there, just to kind of keep it general across the board, the higher or more expensive, it's just showing the buyers that, hey, there's not a large difference. And if you need the loan officer to kind of run some numbers to kind of show you exactly what it's going to look like if you were going to get into that more competitive offer there, we can run the numbers, but usually it's going to be somewhere within that range.
Marie Claire, were you
Okay.
asking about what the fees add to the monthly payment and what that does to what they are qualified for? Like if there's $100 condo fee a month, is that what you're asking about?
What I was asking is this: since when you have the condo, you have
Yeah.
the price of
Yeah.
the
Tell me, say just the question part without
yeah.
it, just the
The
question part.
question part is that when is the condo also we need to think about the condo fees to check to see the condo fees and tell our lender for the condo fees because
Oh, no, the
sometimes
condo fees are in Bright MLS.
okay.
Yeah. Yeah. Okay. So if you are looking at any HOA and condo for any client, take a look at that even before you go show them the house.
Yeah.
Because a
Yeah.
lot of times, like sometimes I'll see condo fees that are $500 a month, $800 a month. And if it's that high, their pre-approval amount is not going to be the same.
Yes, yes, that's
Right.
what yeah, thank
That's
you very much for
okay.
saying.
Yeah. Yeah, exactly. So we want to look at that before you even go show the house. And then you might text Mike and say, hey, I know they're pre-qualified for this amount. I see the condo fee is X. Like, can we still do this? Right.
And condos are a totally different beast. And so one of the questions I ask when clients are getting out there, we're getting them going through the pre-approval process is, are you looking more at single family houses, townhouses, or condos? Because condos are a completely different beast. And you might be talking $100,000, $200,000 price point, but that HOA fee, which is accounted into your housing expense, can be a big, big, big factor. So it's kind of hard to put a number like, oh, well, how much are you pre-approved for? Can't really say exactly the sales price. I can tell you more so what we're looking at on a monthly basis, because as everybody hopefully is aware, as a mortgage lender, we're not looking at specifically sales price. We're looking at the monthly payment, and that's how we're determining what they can qualify for based upon the debt to income ratio, along with the programs and loan type they're using. So to pivot from obviously that's kind of where everybody's head goes first is like if we're trying to make our offer more appealing, we're going to offer more money. And usually that's a big one there, but not always the case here. So 5-minute call to your loan officer to kind of chat with them about the strength of the buyer, any offer strategies, any information. I would recommend calling us. I should have kind of put this slide second, calling us after calling the listing agent, because we'll go over in a second. It's not just about being higher in the offer. It's about structuring smarter and making your offer, your client's offer, more appealing to the seller. So you need to find out what the seller's motivations are here. Obviously, they want to sell the house, but call the listing agent and try and get a hold of them. Some people are just too lackadaisical about that. They just go off of MLS. Find out what their wants and their needs are. Is it about timing? And it's not always just, is it a quicker close? Okay. Right now, I have one that's under contract and with the Keller Williams Capital Properties agent. And so we have a settlement date set up. Everybody kind of knows that might change a little bit because it's the sellers are building a new home and we need to wait until their new home's built. Now feel like we're in a good position now where they're getting pretty close to it, but they're not in a huge rush. Okay. So sometimes putting in a 3-week close isn't as appealing to the sellers because they're like, whoa, like that's a little too early. Our house isn't going to be ready for 2 months. So they might want a longer closing, or they might want to settle to get the money, so settle sooner, but then they want a rent back. Okay. And if anybody's not familiar with a rent back, it's where the transaction's complete, the property is purchased and sold, but the sellers remain in the home and they rent it back from the buyers who are the now new owners of the property. They can rent up to a maximum of 60 days because all the different loan types say that you, as a buyer, if you're buying this as your primary residence, need to move into the property within the first 60 days. So that's the max typically for most primary residential purchases for a rent back. Can be any increment between. It can be a day, a week, a month, or up to the 60 days there. So find out how much they're looking for. And that's something that you can negotiate with the sellers to hopefully help it benefit the sellers so they're more inclined to take your offer, but also benefit the buyers. A rent back can include actual rent. So they're going to be paying money while they're staying in the house. Or let's say that the house is very desirable, lots of other offers, and the buyers right now are living at home, so they don't have a rent payment at the moment. Maybe they say, we'll give you a free rent back. And sellers are like, fantastic. Get to continue living in our house. We don't need to pay money for it while we're waiting for it. That's something that you're going to work with your buyers on and work with the listing agent on. Okay.
Just as an aside, when my son bought his house, that's exactly what we did.
Yeah.
And that's one of the reasons he got the house was we gave the sellers a free rent back. And it wasn't for very long. It was like a week or something, but it was one of our things that we used in our negotiation to get things that my son wanted in the house.
Yeah. And so again, find out what we have with by talking to your loan officer to find out what type of flexibility you have. Because if we're working with like an FHLB right now, we're on some pretty extensive turn times. You can't put in for a 3 or 4 week closing with FHLB and expect to close on time. So the other thing with the call to the listing agent is you are potentially going to be working with this individual or this team to help get through the transaction. Okay. We all understand that you want what's best for your client, but don't come off too aggressive. The sellers will end up getting some advice, usually from their listing agent, their seller's agent, and you can play a large part in this. The buyers, obviously, in their financing, their situation, but you too. If you're a big pain in the butt up front, you're trying to force control and take over the situation, listing agent might say, hey, like we could go with this client, but their agent's a jerk and I don't see it being a very smooth process. We have a very close offer that might be a little bit smoother. Let's maybe consider that one. So you're working together with them. They're not your enemy. Okay. Obviously, again, you want to make sure that you're not just giving in to everything so the sellers get everything that they want in negotiation, but ask the questions, communicate, fill them in on the situation. Okay. Tell them what your buyers are dealing with. And if you can, because I don't think you guys are allowed to supposed to do those offer letters anymore where you can like
No.
have a seller write. So like you can portray, can you still do that with the listing agent? Kind of tell them, hey, I have this young family or young
You
couple.
know what we tell people to do? So here's I'll just tell you what I always say, and this is for everybody, is when I call the listing agent, the first question I'm asking, do you have any offers on the table? Right? Because I want to know, do I have competition? Like what Mike was just talking about, that's going to change the strategy that he's talking about if I have competition or if I don't. And then the second question is, other than price, what's important to the seller?
Yep.
Right. So those are my two questions. And then when I'm talking to the seller about my client, I should really focus on like why my client is going to get this deal done. Right. And so it might be talking about my lender. Like that's part of my team. My lender, I've worked with this lender for a long time. They're going to recognize even if they haven't met Mike before, they're going to know his company. He's a local lender. You're going to CC Mike on your offer because he's going to call the listing agent and tell him how wonderful your buyer is. All that stuff makes an enormous difference.
Yes. Yes. And Dallison and myself, the one we have under contract right now,
I
happened
was just going to
to,
mention that.
what's that?
I was going to mention that one. Though
Yeah.
from the contract, Mike knew the listing
Yeah.
agent, so he was able to call him and talk to him.
So hopefully, again, that's why you work well with the people on the other side there, because he's more of a listing agent. He does some buyers and works with one of our one of my branch teammates, and so I have a good relationship with him because not only of our reputation, but how our past deals have gone. So you might think that this is your only deal with this potential agent because there's tons of agents out there, but you might end up coming across them again. So you want to make sure that everybody's again working together and everybody leaves on good terms. We're in a lot of us are in Baltimore. I mean, some of you might be in some other areas there, but like Baltimore is known as Small-Timore. So word gets around and people know each other. And so especially in a business like this, like those contacts can definitely help out and making things a little bit smoother and more appealing. And so I've had multiple contracts accepted, and it's because and we weren't the strongest in regards to what we were offering up for the sales price, quick close. It's because the listing agent went back to the seller and said, "Hey, work with these guys all the time. If they say these buyers are good, they're good. You don't need to worry." And so having that peace of mind, knowing that we're going to get to the table and on time, because I will set proper expectations. I'm not going to tell somebody, hey, we can do 30 days if I really don't believe we can do that. If you want to do that because that's the only way you think you're getting the offer accepted, that's on you. I'm totally fine with that. We'll deal with it down the line. I don't usually recommend it because, again, that's part of the communicating and working with the other party. But if that's a big difference, that's something you can work with. So there's so many questions to have answered. Ask the questions. Ask about the other offers, find out what's important so you can figure it out. Because you might go with your client trying to get rid of all these contingencies. Hey, how do we get rid of our home sale contingency? Should we waive inspection? All these different items that you might not have to worry about if you're the only offer in and the property's been on the market for a while, you have a little bit more of the upper hand. The property's been under contract before, okay, and it's fallen through, find out exactly what it was, okay? It might have been something on the buyer side, might have been something on the seller side. Find out so that you don't come across that same issue down the line, or if you kind of see that being a potential issue, that everybody can work through it together. Now, this is going to be a little bit more for high net worth clients, or more specifically clients with larger down payments. But this is something that a lot of people don't always think about or consider, but can be very useful, especially if you're looking in desirable areas and competitive situations. Seeing if we have an appraisal waiver. Appraisal waivers are a little bit more common when a buyer is putting down 20% or more, but you can potentially get them with as little as 10% down. They're only going to be on conventional loans. But if nobody's familiar with an appraisal waiver, it's basically Fannie Mae and Freddie Mac, which are the two government-sponsored entities for conventional loans, saying, hey, look, like we see you're putting down enough money. And now they document all appraisals. So if the buyers had, or the sellers had refinanced in the last couple of years, or the property was sold or purchased in the last couple of years, it's documented. They say, hey, look, like we see you have enough skin in the game with your down payment. We see these past documented values and comps for the area. We think that we're safe enough letting you move forward without require an appraisal. So not only does that, it doesn't mean that you don't have to get one done. It just means your buyer has the ability to decide to get one or not. If they don't want to get one done, they save themselves probably about $600. And that is a big contingency that the sellers don't need to worry about, because if you're offering, especially again, competitive, offering more than the list price, and the listing agent says, I like your offer, but I'm not sure the house is actually worth that much, or should say it's more so it's going to appraise for that much. Getting rid of the appraisal waives that, and that is a big contingency that a lot of sellers very much like to see. Plus, without having to worry about the appraisal, that means we could probably close quicker, assuming that the buyer's financing is fairly clean and the title work comes in. That you would have to check with your lender. And usually, like for somebody like myself, I'm going to keep an eye out for that. Okay. We have to run it through specifically through our automated underwriting system. But if I see somebody's putting down 10 or 20%, I'm going to run it through to see if we can get that, because then it just takes a couple of minutes for us to figure that out. And that could be a big difference maker. Okay. Appraisal gap coverage. And Kirsten, if you want to kind of chime in a little bit about this, you can, just because you guys are seeing this a little bit more. And I don't know if there's certain strategies, but that's where you're putting in an appraisal gap coverage in your offer, saying, hey, if we know we're offering more than you had the property listed for, because we're against competition here and we want to get this house, we're willing to pay more, but we're concerned, or the listing agent or the buyer's agent are concerned that the house might not appraise for that much. You can put an appraisal gap coverage saying, hey, we will cover up to $15,000 difference in appraisal. So even if the house you offer 500, the house only appraised for 485, that means that your buyer is saying upfront that I'm willing to bring that extra money to the table. Okay. If it only appraised for $10,000 left, they only need to bring the 10, but they would say they'd be willing to go as high as 15. If the house only appraises for 480, then you have to negotiate. But at that point, the sellers know that you are willing to cover up to 15. So even if they have to cover the other 5 or negotiate, maybe they do try and get your buyer to pay the other 5,000, then that's something you guys can work on. But this makes the sellers and the sellers and listing agent feel a lot better if you're putting in like a strong, aggressive offer, because you can offer whatever you want, but if the house doesn't appraise and there is an appraisal required, then it doesn't mean anything. Okay. Making your offer stand out. Again, communication can be a big one, because a lot of people want to see that. So make sure you call your loan officer, make sure you call the agent. We'll find out, and I'll hopefully bring it up, but if you're putting down a good chunk, ask your loan officer about the potential of an appraisal waiver. What do we got, Dana? What's up?
Hi.
Hi.
So I'm so sorry. I have a question about the gap coverage part. I saw it and I was like, oh, I get it. And then as soon as you explained it, I was like, uh-oh, I don't get it. And I don't know why I don't get it. It seems simple, but so it sounded like you were saying that, like, if someone lists their house for 500,000 and they get in, and I make an offer for 500,000 and I get it appraised, like by my lender, and they appraise it for less than 500,000, is the gap coverage saying that I'll pay 500,000 anyway?
So if there's no appraisal gap coverage in there, okay, there's nothing stated saying you were going to cover any difference, then you're essentially back to negotiations, because you're offering $500,000 for the house, but the house appraised for 490. And when we're doing the loan, the financing, it's always going to be based off the sales price or the loan amount, or sorry, the sales price or the appraised value, whichever's less. So if they're putting down 10%, now they'd have to put 10% on the 490 and have to come out of pocket with that $10,000 extra. So if the house appraised for 490, but you're under contract for 500, without the appraisal gap coverage, either the seller has to drop down to the 490, and that's the new sales price, which would be great, but they're not guaranteed to do that. The buyer can decide, hey, okay, like, we really want this house, we're going to come out of pocket with that difference of the 10,000, or it could be a combination of the two. So the seller could drop their price by 5,000 and you could come out of pocket with the difference of the 5,000. So that's, with no appraisal gap coverage, basically says, hey, if it doesn't appraise there, then we'll renegotiate there. And if nobody agrees, then you have to walk away and deal's dead. By putting in this appraisal gap coverage, it's giving the sellers some wiggle room if the house isn't to appraise. So it makes them feel more comfortable because they understand if it doesn't appraises by less than $15,000 less, we still have a deal. If it praises for less than that amount of money, again, whether I should have used the same scenario, but the 10 or 15, if it appraised for 450, then again, you're still back to the table to renegotiate because
Okay.
you might not.
So it's like, as a
money
buyer, here's what I'm willing to pay within a window of, within $15,000
if it doesn't appraise.
for, I'm willing to pay this amount in this window in case it doesn't appraise for what I made an offer for.
Yeah. Yeah. Because again,
Yeah.
for any offer, I mean, like you could go find a $500,000
Does
house.
that happen often? Like, who puts their house on the market for, like, honestly more than they know it's going to appraise for? Because they're
Kirsten,
going to run
tips
into
on
that.
that.
They're
Yeah,
going to
let me,
run into
you know
that
what?
offer after offer.
You run into it a lot.
Yeah.
No,
Really?
it does happen because you know what? First of all, if I have two appraisers come out, I'm probably not getting the same number with both of them.
Yeah.
Okay, so it's
Oh,
not like there's a black and white number that house is worth. Okay,
okay.
and like every house is different, and so if I'm in a townhouse neighborhood where every house is so similar, they're very likely to be pretty close. But
Yeah.
older, like houses can be unicorns where it could come at all different amounts. It happens fairly often.
Oh,
Yeah.
okay. Okay.
Yeah.
All right. No, that makes sense. That was the other thing. I was like, why would we ask people to, like, basically insure, like, here's my insurance policy to you that I'm not going to back out of this deal as long as it's within this dollar amount. I was like, really? Like, they would pay more for a house than what it's worth, but it's
But,
not
but,
like
but, but
that. It
what
doesn't
it's
seem
worth
like it
isn't a
is
thing,
like that.
right? What it's worth isn't
Right.
like a set thing. And
Right. Right.
what it's worth is really what a buyer is willing to pay and a seller is willing to sell it for.
Yeah.
And that number could be very different in 2 weeks from what it is today. Do you know what I
Yeah.
mean? So a
Yeah.
lot of times the seller isn't all that concerned about it because this is the house. They love it. They're planning to live here for the next 20 years. I don't care if that's $10,000 more. I still love this
Right.
house, you know?
Yeah.
Right. No, and it makes sense as a lot as a offer tool, So I get it. Okay.
And
Thank you.
especially people want to be in specific neighborhoods. Let's say you buy this house for it's offered listed at 500, tons of offers because everybody wants to be in the school district.
Yeah.
You decide you're going to pay 600,000 and people are like, that's crazy. $100,000 more than what's worth. But if you're going to be in this house for 20 years, when you go to sell that house might be worth 800,000. So, and yeah, it would have been nice if you could have gotten it for lower, but there's competition, and usually they're not just straight up offering $100,000 more. They're usually just offering a little bit more than what the next best offer is.
Mhm.
So there's lots of different scenarios out there, and you can't compete with crazy. So sometimes when you're working with your
Uh,
clients, you also need to be able to like, hey, like we need to have a max here because we know you want this house, but like there's got to be a max you're willing to
oh yeah.
there. Dallas, did you have your hand up?
Yeah, I was going to also mention too, sometimes like the seller could have paid over a certain amount when they bought the house and they could have like negative equity because I ran into that recently when I was working with my buyer. That was the that was the issue with one of the sellers, and then the other seller refinanced and was trying to sell, and he still had negative equity. So it could be a variety of different things, but that's why it's important to talk to the seller's agent because usually they'll tell you that information, so you kind of have a better idea of what's going on.
And
And
in
also,
terms of
Because
wasting
both of the homes were overpriced, and that was one of the struggles that those sellers were having.
yeah. And you like for those who might be newer at this or not right ton of offers, it takes time to put these offers together. So if you're asking these questions up front, you might be able to determine from a 5-minute phone call if your client should even spend the time writing this offer because it might be dead in the water. So you put it in there for whatever reason. Maybe you're trying to get more aggressive and you're going to offer $20,000 less, but like Dallas mentioned, they can't go that low and they're not willing to. So why would you take all that time writing that offer, going over everything with your clients there just to find out, hey, this is an option. So do yourself a favor and ask the questions up front. And hopefully you're working with, there's definitely different walks of life on the other side. So hopefully you're working with a listing agent that's going to provide you all this so that you guys can all work together. Some of them are a little salesy or something like that. We'll just tell you kind of what you want to hear, but not necessarily always it. So, doesn't seem to be skipping. I thought I had a couple more slides here. I'll see if it comes up, but a couple other things I want to go over was just being able to open up more inventory, or if you find a house that might need some work. So as is, all right, if you see an as is property, there's probably going to be something in the listing about either cash only, investment purchase, but sometimes you can do a renovation loan. Okay. So renovation loans are good to get familiar with because not only could it take this property that's in need of some work and allow you to be able to put the work into it using the loan. Also, this might also elaborate on the, or kind of spread out the inventory for your clients. Maybe they're looking in a specific area and you only see a couple of properties that are listed that meet the specs that they wanted, the 3 bedrooms, 2 baths, and there's a couple of their 3 bedrooms, 1 bath. Just because they don't have that extra bath, maybe use a renovation loan to open that up. And that's not in regards to structuring your offer there. But if the house is as is and you come in there and do the work via a renovation loan, sometimes the sellers, if they don't, because they if it's as is, they're probably going to have a bunch of investors putting in cash offers, which is great, but the investors want to get that number as low as possible. So they're going to be putting in lowball offers. And if you come in there with a more reasonable offer, yeah, it's going to take a little bit more time. So you got to talk with them if they're in a hurry to get out of the house and we need 45 or 60 days for the renovation loan. Find out those questions. But if you can do that, you might be offering more for the property than those investors and getting it because you're willing to do the work, or your clients are willing to do the work.
Hey, Mike, this is just between me and you, just in front of everybody, but let's put you on the calendar to talk about renovation loans.
Okay, cool.
Pretty soon.
Absolutely.
Is that good? All right, cool.
There's a couple different options. And one of the slides kind of went into, I'm not sure why it's not going to that now.
Like
But the other,
3K or something.
yeah, so there's FHA 2 or 3. Here we go. We got one in the other. So
Okay.
here, I'll do the renovation loans real quick. So for FHA, you have your FHA 203K. Great thing with those, you can put down 3.5%, which is the same on a single unit property with FHA. And you can get in there and go do the work. Fannie Mae home style sometimes can require more down. It really depends on the income. If you meet the income requirements, sometimes it'll require you to put down about 5% or so. But these are some low down payment options that might be feasible. Note, most down payment assistance options don't work here. So the client's going to have to be in a decent enough position to kind of at least put down the down payment. Hopefully we can negotiate to have the seller cover the closing costs to kind of keep their cash down, close down low. Another reason FHLB grant is unique is one of the few down payment assistance options that will allow you to do a renovation loan with. So that's great while that's available. So yeah, let's definitely do one about renovation loans because they are good to know about. Bridge loans. This is also one that's a little bit, not necessarily higher net worth clients, but not your first time home buyers. If you have a client that currently owns a home and maybe they don't have a lot of cash, maybe they do have a lot of cash, but maybe they have a lot of equity in their current home, these can be great options because they can get rid of the home sale contingency. So let's say your client has $200,000 of equity in their current home and no cash, okay? No liquid cash, tons of money. Your options are either to go in there and put the contingent offer in, say, Mr. or Mrs. Seller, want to buy your house, but in order to buy your house, I need to sell my house because that's where all my money's coming from. That's one option. Takes a long time. These days, sellers don't love the home sale contingencies. Some houses are sitting on the market for a while. Some are selling super quick. So a way to get rid of that is doing a bridge loan. And a bridge loan was a loan that will allow you to tap into equity to be able to use it for the down payment and closing costs. We don't need to count the current mortgage payment against them, so it helps them qualify. And again, that's getting rid of that home sale contingency. So if you have a client that has a house that they're looking to sell and buy a new one, definitely look into this. We have 4 different bridge loans. All of them are a little bit different, have different benefits. So we'll kind of see which one's best suited for your clients. Okay. And after focus there is to get into the new home. After they get into the new home, then it's prep and sell the house. It also just makes the process a lot easier for your clients.
And Mike did a whole session on bridge loans like maybe a month or 2 ago, and the recording is in the coaching community. So you can watch that whole thing for more information about bridge loans or reach out to Mike.
Cool.
Can I ask one quick question? Not necessarily about a bridge loan. And if you're just like Dana, go watch the recording. That's fine. But how, I just thought about it. How is it different from a home equity loan?
And actually, I was going to wait till you finish. I was like, I kind of want to go over that as well. So,
Okay.
and this, Sarah, Dana, can I use your situation?
You can,
Okay.
sure.
So Dana's dad is looking to purchase a home and he owns his home free and clear. And so for him, what we're trying to do, because financially speaking, this is going to save him a little bit more money, is the bridge loan is essentially a home equity line of credit just with the intentions of selling the home. And it does have some additional benefits as well, which you can go back to the recording for those. But you're pulling out equity from your home to use towards the purchase of the new home. With the home equity line of credit, you can still go do that. Okay. And if we are planning ahead of time with clients, because her dad's looking but not seeing much out there, so he's well ahead. When you're opening up a home equity line of credit, if nobody's familiar, it's a line of credit. So it's like a credit card based upon the equity in your house. Okay. So if you have let's say you have 800,000 or $1 million home, or sorry, a $500,000 home, and you can pull up to $400,000 out. Okay. In the form of a revolving credit. You can use it for renovations. You can use it to purchase a car, pay down debt. You can really use it for whatever. You're not necessarily supposed to be using it to go purchasing more real estate, but tons of people do it. As long as you don't kind of go out there and straight tell them, hey, I'm pulling out this home equity kind of credit to go buy a new house. But pull out the money. You pull out the 400,000. You don't, just because it kind of sits there. Okay. It's like a credit card, sits there. You're not paying on it unless you're using it, but you can pull out that money. And then if you do find a house, you can then use that to either go purchase the home in cash, which we're hoping that her dad can do, or use it for your down payment and closing costs. Okay. So if he's buying a $600,000 house, but only has 400, he'd have to finance the rest. So you can still do a home equity line of credit with that one. It's just, her dad doesn't have a mortgage, so he doesn't have a payment and has a lot of equity. So that's probably a better option for him. People that don't have as much equity or still have a payment, if we have to count both those payments, you might not qualify. Okay. Or maybe we're trying to pull that money out to cover the down payment, kind of paired with that one. So there are different benefits. The bridge loans are geared towards clients that intend to sell their house afterwards. That's kind of the more traditional route. If you're going to sell it, then you do the bridge loan. If you're going to hold on to it, use the HELOC. But Dana, I see your face. In your situation there, it still makes a lot more sense for him to do the HELOC if possible.
Yeah, no, well, and I thought there was a third one too, like the actual like loan, like a home equity loan as well, right? Or do people just calling that home equity line of credit two different things?
So
The same.
it's usually referred to as a HELOC or home equity line of credit.
Oh, so
And
there's
that's
not
what,
like a line of credit and a home equity loan. They're like, that's just the
well,
same
you can,
name, different name for the
when,
same thing.
yes and no. So essentially, in theory, they're the same thing, but I guess it's going to be how they're structured. So with the home equity line
Okay.
of credit, it's going to be a little bit more revolving. Okay. So
Yeah.
that's where it's like works like a credit card. So you can go out there and charge it.
Right.
Yep. Do $100,000 renovation. Then you have to make payments on it. Once it's done, you kind of get the balance back to zero. Or you can do fixed ones. That's like more of a second mortgage. Okay. And that's where you get out a fixed amount and you're going
Oh,
to have a fixed payment to go with it.
got it. Got it. Got it. That's helpful.
So
Okay. Thank you.
really what want to do that wouldn't really make sense for that situation. That's more of a kind of fallback safe if you are in dire straits or just need to replenish cash, pay down some debt using that
Yeah.
equity. So a line of, or not a line of credit, but the home equity loan, the second mortgage is probably a better option there.
Okay.
Okay. Um, yeah, so call your loan officer, call the listing agent first, then call your loan officer because then you can share that information so that we can strategize together. We'll figure out a good, clean offer to submit, put your offer in. And then you can also do little nuances. I don't know if anybody wants to kind of chime in with anything. I have one agent that always likes to offer up a odd number. So if the house is listed at 200 and they're trying to get a little bit more aggressive on their offer, they might offer 202,562 bucks. So something random, but for some reason I feel like she gets her offers accepted a bunch, and it's maybe because they stand out a little bit more. She also communicates and finds out what's needed, so she's very good at that sort of stuff. But that's one of the unique things that she does that, again, stands out a little bit. Doesn't mean it's going to be the difference maker unless it's really offering that much more money. Trying to think. Anybody have any questions or scenarios that you want to go over? Feeling pretty good. Was this helpful? Yeah,
Could you come back to that slide again, Mike? Thank you.
absolutely.
Mhm.
This one
Yep.
right here.
Yeah, thank you.
Oh,
Yep, I miss it.
no worries. And if I think that Kirsten had also recorded this, so hopefully it'll be accessible a little bit down the line.
That's right. I
Okay.
did record it, so it should be by this weekend online.
Okay. Thank you very much, Gerton.
Takes on
Yes.
the situation or call the listing agent, be friendly,
Yep.
get as much as you can. And sometimes you can do some research of your own as well. Pull up Maryland SDAP, pull up the tax bill, pull up land records. I can send you links to any of that sort of stuff you guys need it. Try and find some information, but find out what the motivation is, find out what the situation is, because that's very much going to play in your offer, because you can structure the offer the way you want it, but it doesn't mean that that's what the seller wants. All good.
Awesome. Well, thanks, Mike. This was great. I think it was really helpful.
Yeah, it is. It-
Yeah, so recording will be online soon, and I'm gonna check in with Mike and we'll figure out when we can do that renovation loan class because I think that would be really helpful as well. All
Love it.
right, thanks for joining me and see you all later. Everybody have a good weekend. I'll see you sometime next week.
Bye,
All
guys.
right, thanks everybody. Bye.
uh,
Bye.